Welcome everyone to today's webinar. My name is Matt. I'm the founder of Q4Launch, and I'm excited that you guys are along for the ride with us today as we tackle Expedia's Q3 earnings call and what you need to know. Tons of information packed into today's webinar regarding what's going on at Expedia, more pointedly what's going on at HomeAway as we really examine that part of their overall business as that most impacts what we're doing as an industry. And then what do we need to do about it? Looking ahead at 2018, and we're going to have a webinar, I believe it's next week, about building your 2018 strategy, how to do that effectively, and everything that goes into that. But really honing in on all that, kind of bringing us together. So those are the things we're going to be touching on. What do we learn from the call, and what do you need to do about it, or what do you need to know? What do you need to know, obviously, leading to what do you need to do about it? So a little bit about Q4Launch. I think we have several first-time attendees on the webinar today. So a little bit about us. We are a destination marketing company based in Charleston, South Carolina. We work with some of the top destinations and vacation rental management, hotels, inns, B&Bs, from Singapore to Maui and just about everywhere in between. So represent a wide depth and breadth of customers and are very blessed to be able to do that, all headquartered out of our Charleston office here. So it's a little bit about us. I'm the founder of the company. I founded the company about 9 years ago. We've been exclusively focused in the travel space for about the last 4 years and have been having a great time at it. This webinar series is a part of a roughly bi-monthly webinar we do just to share what's going on in the industry, what we're seeing, and the information that we are looking at and paying attention to as it relates to what's going on in the broader industry and how that can impact your strategy for your business. So hopefully that's helpful for many, as I know it is, as we see a lot of repeat visitors to our webinar. So thank you for tuning in, and hope you come away with some new ideas and some action items to apply into your business in 2018. So it's a little bit about us, but with that, let's dive into our content today. So one other housekeeping item, we will be sending a copy of the recording out of the webinar, so you can definitely look for that. We'll be emailing that out, as well as we'll be using the chat panel for any questions and answers that you have together. So we'll set some time aside at the end for any questions. If you have any, let me know, and we'll definitely get to that. So feel free to drop those in the chat panel throughout our time together today, and then at the end we will circle up and get to those questions. So with that, let's dive in and figure out what we learned on our call. As we do that, I do want to give a big shout out to Amy Highnote from BRM Intel. I used the summary that she wrote for her blog to pull together some of my thoughts. So I wanted to give her a shout out for that and for kind of bringing that summary of the transcript of the earnings call together, just as one of the big sources we used to look at as we were pulling together what was actually said on the call. So some of the quotes we pull for actually come straight from Amy's blog. So let's start looking at some of the data. Today's going to be a very data-driven call in the first half, and then probably a what do we need to do about it is going to be a little bit less data-driven and more strategic, and there's going to be some assumptions in there as well, because anytime we're analyzing another company and what they're doing, we're going to make some assumptions on where we think the future is headed. So one of the things we do know, and this is not an assumption, this is the data part, is that Expedia's revenue increased by 15% in the third quarter of this year to $2.97 billion, but missed forecast by $10 million. When we saw that, or if you track the stock price, which we're going to talk a lot about this company as a stock today, their stock went down 16% in after-hours trading. So after their third quarter's earnings call, their stock dropped 16% basically overnight, and then over the next couple of days continued to drop. But it's not because they missed their earnings by 10 million, because on 3 billion, 10 million is actually a really small number. I think the bigger reason that their stock dropped so markedly overnight was that they lowered their EBITDA outlook from a 10 to 15%, so essentially their profit margin, from 10 to 15% to 6 to 9%, which is a huge reduction in profit margin. And what's driving that increase in cost? We missed our revenue forecast a little bit, but not by much. But what it sounds like, if you're really doing the math and just getting the basics of revenue minus cost equals EBITDA or profitability on a very basic level, their costs were a lot higher than they anticipated them being. So that's a big factor we've got to look at and understand why were their costs a lot higher, and how do their costs being higher impact us as an industry. So that's something we want to take a look at, something we're actually going to speak to here in a few minutes. But that was the basics of it. There's a lot more detail that we went into and we're going to unpack. But as we do that, and it kind of led me to look around the travel industry as a whole, and I'm sure you guys have seen several highlights or headlines about some of these other companies as well. But the third quarter was actually a tough quarter for some of the leading travel stocks or travel companies. Priceline lost 14% after their third quarter earnings call, which was roughly $14 billion. So overnight, Priceline stock lost $14 billion of value after their earnings call. Priceline has since recovered about half of that, or $123 a share, updated based off of last night's trading. TripAdvisor lost 25% after their third quarter earnings call, so an even bigger loss. Good news, TripAdvisor has recovered about 50% of their loss. But when you look at the industry as a whole, the travel industry as a whole, it was a rough quarter for travel stocks. And there's a lot going on there. There's a lot of reports out that say the hotel industry as a whole had their worst quarter since 2010. So there's a lot of data out there saying it was a tough quarter across the travel industry as a whole. And I believe that's reflected by what we see in the slowdown in hotel growth, as far as measured by RevPAR and occupancy, but also what we saw as a response from these three major stocks in our industry taking significant drops in the way that they did. So we're going to unpack that a little bit because I think there's some lessons we need to learn out of that. So why such a tough quarter for the OTAs? Kind of grouping TripAdvisor into that OTA category now, as they've made a lot of changes in the last few years that put them in that category. But Google's winning the travel industry in every feasible way. That's kind of the moral of the story. You know, Google as a company has launched Google Travel. And it wasn't this big formal launch, but it was something that's been happening over the years. And as a part of that, they're winning the travel industry. The travel industry is one of the top spenders on pay-per-click, and specifically Expedia and Priceline are two out of Google's three largest pay-per-click customers. So when you look at it, Google's actually winning this industry a couple different ways. One, they're winning it because search, and they dominate search from a market share perspective. But specifically Google Travel, the travel brand of Google, is growing at an extremely fast pace and is estimated to be worth $100 billion, which is more than Priceline and Expedia. So think about that. Google Travel is now worth more than Priceline and Expedia, just that one division of Google, which makes sense, right? I mean, Expedia and Priceline are all about controlling the customer relationship and trying to own that customer. But think how many customers that Google owns. Think of the market share that they have. And by being able to release a new product into that market via Google Travel and controlling everything around how travel is searched for and booked, they control a huge part of the market, more so than Priceline and Expedia already. And as we look at the future, what that looks like for OTAs, and this is kind of a brief note, but Amazon has tried to enter this space previously and failed in doing so, and they pulled back on that a couple of years ago, but will likely try again. Amazon is in the same path of Google as far as internet domination and trying to control the internet and trying to control where dollars are spent. And if you look at any of the statistics coming out on Black Friday through Cyber Monday, that whole weekend of sales, and the stats on how much of the revenue was controlled by Amazon over the last 4 days of shopping, it's unbelievable the amount of market share that they have captured in the last 5 years when it comes to not just when it comes to total revenue as well as revenue spent online. So Google and Amazon, absolutely dominant players, and we believe Amazon will make a push to get back into the travel space in a bigger way. Don't know 100% what that will look like, but I'm sure they will be making a push because it is such a hot industry and a growing industry that's getting so much attention. So as we look at that and we look at why it was such a tough quarter for OTAs, one of the takeaways for you is that your search presence is more important than ever. If you've been on webinars with us in the past, you've heard me talk about the fact that we see about 40% of our customers' traffic coming from Google organic search. And as such, we would assume that 40% of their direct bookings come from Google organic search. If 40% of our customers are finding this that way, So it's a huge deal. It is by far the largest sector of where people are finding our customers from. And I imagine if you look at your Google Analytics, you'll see something similar. Anywhere from 30 to 50% of your traffic is coming from Google organic search. We believe 40% is a good goal because it's not so much that your other sources aren't performing as well as they should be, right? If it's higher than 40%, chances are your other sources aren't performing as well as they should be. If it's lower than that, chances are your organic isn't performing as well as it should be. So believe that 40% is a good target, but your search presence is more important than ever. And search is changing. I was meeting with our content team who creates a lot of our search content last week with their weekly staff meeting, and we were talking about the future of voice search. And there's so many people talking about that now, but what does that look like? How do we optimize for that? How does our content need to be different based on the way people are searching for voice? A lot of these questions that have to be answered, and search is changing, and Amazon is getting into the search game in a big way because that's what Alexa essentially is. She's a search tool, right? People are asking questions and she's providing answers. So she is searching for the answers to their questions, much in the same way Google does, but usually off of a different query. And Amazon is training people how to interact with Alexa every time they release a TV commercial. Every TV commercial is about getting you to buy Alexa, of course, but it's also about training you how to interact with Alexa. And how to do that well. So there's a lot that goes into that and why they're doing those things. So that's just a little bit about why it was a tough quarter for the OTAs. Of course, there's other factors. It was a tough quarter for hurricanes and natural disasters. There's a lot of other factors going on in that, but that's definitely one of the biggest ones. And just looking at the competitiveness from a marketing perspective in the travel industry. So here's some of the highlights specifically from HomeAway. Part of the Expedia call. I don't usually put huge blocks of text in here, but we're going to talk about each of these things individually and then want to make a slide for each of them. HomeAway delivered $305 million of revenue as part of Expedia in the third quarter, which represents an increase of 45% year over year. 45% increase year over year at HomeAway's revenue. Absolutely unbelievable growth. And considering the growth they saw last year, growing again on top of that is absolutely astounding from a revenue perspective. Room nights booked on HomeAway was up 36% year over year. So a lot of people formulated and forecasted that the service fee would drive people away from the platform and that they wouldn't book on there. But room nights, according to them, are up 36% year over year. I think if you look at their inventory growth, it would be somewhat consistent with their inventory growth. But HomeAway offers nearly 1.5 million online bookable listings. To kind of contrast that, Airbnb claimed over the summer that they have 4 million online bookable listings. So still well behind on the online bookable listings, but has put a big stake in the ground saying they're going to focus on whole home bookings and whole unit bookings, although many hotels and bed and breakfasts are listed on HomeAway's family of sites now. So the difference there being, though, you're still booking a whole unit. It's just not the whole home as some of their marketing and TV commercials kind of tie into. So some discrepancies there. 95,000 of those 1.5 million listings are now on 28 brand Expedia, Orbitz, Travelocity, Cheap Tickets, and eBookers points of sale, up from 65,000 in Q2. So basically what that says is 95 of their listings are distributed throughout Expedia's family of websites for instant booking through that channel. And those bookings come in at the 15 to 25% range from a commission perspective, whatever the deal that the people who have those listings has negotiated with Expedia as part of that. So those are coming in at that really high commission rate for the industry as a whole. And that's a big growth from 65,000 in Q2. It's still a really small number when compared to the 1.5 million online bookable listings. But I think they're making big efforts here, and I think it will continue to be a challenge for them to really get this inventory all integrated together and get it to show side by side in a way that the consumer really understands what they're booking. Because consumers tend to make fast decisions and not really understand the decision they're making a lot of times when it comes to this. Over 1/3 of HomeAway's nearly 1.5 million online bookable listings are now instantly bookable. So these two things are a big push for them. One, the instantly bookable is a big push for them. Two, getting the listings distributed across the brand of websites. So when you look at HomeAway's traffic across their, I believe, about 100 websites that make up the HomeAway family, it's a lot of traffic, but it pales in comparison to the amount of traffic that the Expedia brand of family of brands has. So they know, as they're driving conversion rate higher, if they can get their properties in front of more and more people, they are going to get more and more bookings, right? More properties in front of more people, they're going to get more bookings. It just makes sense. So it's a big push for them, one, to get properties instantly bookable, because you have to be instantly bookable before you can really get on their platform. And then once you're instantly bookable, get you to distribute through Expedia at those 15 to 25% commissions, because at 15 to 25% from a vacation rental booking, that's a lot of money, because these are high dollar bookings, whereas traditional hotel, B&B Inn bookings are much smaller dollar amounts. So a lot going into that, a lot of financial motivation at stake there. And HomeAway continues to roll out updates of its secure messaging platform for its North American and European sites, with pre-booking communications now facilitated through secure messaging system for over 65% of listings. Basically what they're saying is the rollout of their pre-booking communications being all on their secure messaging system is going well, and they're continuing to push forward on that, which of course we didn't expect anything else, didn't expect otherwise. They don't usually go back on things. I think the only thing they've gone back on is their claim that everything had to be instantly bookable. I believe by the end of this year was the original mandate. I can't remember the exact date on that, but they did back off of that one thing. But everything else, they've kind of stayed on and haven't backed away from any of those firm marks in the ground, if you will. So that's a lot. There's a lot going on. Some of the other big things they talked about was the pace of change and how much change. Their CEO talked about how much change the team at HomeAway has driven this year. And if you really look back over the year, and we're going to talk about this in next week's webinar, they have driven a tremendous amount of change this year to date, with a lot of progress made on a lot of strategic initiatives. So let's look at a couple other things. We want to take a brief look at the financials. I know numbers and financials can get people a little bit glossy-eyed, but we want to talk about this a little bit because I think it's a really big deal. And I think it speaks to the future of where the platform is going. But when we look at it, gross bookings grew by 44%, while revenue grew by 45%. So revenue growth coming from gross bookings. They break that down further for us. One point of note, and I didn't have my notes together on this with the call we did last year after their third quarter earnings call in 2016, but in 2 years, Expedia has more than doubled the revenue from HomeAway. And more important than that, they are growing profitability at a rate much faster, actually, than they're growing their revenue. So while Expedia is missing targets, for the HomeAway sector of the business, they're hitting and exceeding some big targets. So let's break that down and try to understand where that revenue growth came from. First part of it, we look at transactional revenue. Transactional revenue is primarily the service fee. That revenue exceeded more than 75% of their revenue for the first time in company history, and was 116% growth year over year. So basically, and I don't know what all they include in this transactional revenue, but we know the service fee is included in there. That is now more than 75% of HomeAway's revenue, as opposed to subscription revenue, which used to be their main source of revenue. Subscription revenue has now decreased by 37%. They named that statistics. Subscription revenue decreased by 37% year over year, whereas transactional revenue exceeded more than 75% of their revenue. So lots of different statistics. I know, let me kind of pull that together a little bit. But transactions make up more than 75% of revenue. Subscriptions and other revenue sources, subscriptions for the platform and other revenue sources, make up less than 25% of their revenue and decreased this year. And they are alarmed by the fact that it decreased. So I think the fact that it decreased and they're not surprised by that, and at the same time their revenue grew by 45% and their profitability grew, that shows you the direction that they're heading the platform in. That's kind of the takeaway from that, is that they're okay with the fact subscription revenue is declining significantly. 37% year over year is a significant decline, and they have no plans to try to stop that decline. So that is an indicator of future plans when you look at how all this comes together. And that's why I think looking at the financials is such an important part, because I think it speaks to the direction the company is headed as a whole. So here's a little bit more information on those financials. HomeAway reported their highest quarterly EBITDA, earnings before interest, tax, and depreciation, amortization, in company history at $126 million. So essentially the third quarter of 2017, while it was a very tough quarter for the OTAs as a whole, was HomeAway's most profitable quarter ever. And that's a 63% growth year over year. So to kind of compare that, they had a 45% increase in revenue that led to a 63% increase in profitability. So that's huge. It means the same thing happened last year, but they're growing profitability at a faster pace than they're growing revenue. And that's a really big deal because it shows where money is not being spent in the future of HomeAway. And it shows how much they have really been able to squeeze out of that service fee since launching it and since buying HomeAway from HomeAway, since buying the company and a family of companies. We talked about it in that webinar that we first taught on the service fee and what it meant as a financial piece. That was about 2 years ago we taught that webinar, but we kind of quantified what the service fee was going to mean in the future from a revenue perspective and why it was such a great acquisition and what all that looked like. And the great part of, and we talked about this as well, but implementing that service fee did not lead to a dramatic change in the cost of doing business for HomeAway. A lot of HomeAway's cost of doing business is in customer acquisition. And no matter what they charge the customer, and this is kind of a gross overstatement, but no matter what they charge the customer, the cost of customer acquisition does not change. So by implementing that service fee, they dramatically increased their profitability, and that's played out. That was our prediction, and that has absolutely played out since then. When you look at it, that $126 million of profitability on $305 million of revenue is a 41% profit margin. So I don't know what profit margins you're running in your business. If you look at the average hotel and just use general hotel data, the average hotel runs about 25% profit margins. In the third quarter, HomeAway operated with a 41% profit margin. Takeaway from that is the service fee is working and it is hugely profitable, which leads to the question of what other fees could yield similar results, right? They have to be asking themselves that question as they're looking at the value proposition. What value are we providing to the marketplace? They have determined that they're providing great enough value to the consumer that they can charge a 6% service fee. A lot of people said they were wrong and that bookings would decline, but according to their data, bookings have not declined. They have increased, and the service fee has been extremely profitable at the same time and has been extremely successful for them, which leads to the question of what other fees could yield similar results. And if you've already rolled out your service fee, what other fees could you be looking for? What other part of that value equation could you look for to say, where else can we capture money? And we're going to talk a little bit about that because I think the writing is on the wall for some very clear changes that we can expect from HomeAway in 2018. We're providing great value for consumers and we're charging them 6% to do it. We're providing great value for vacation rental managers, hoteliers, innkeepers. What's the value proposition look like for us on that side of it? What's the value proposition for Expedia on that side of the equation? They've already addressed one side of the equation, and I believe they're going to address the second side of that equation. And we're going to talk about that in more depth. So here's another one of the takeaways that we think is really important, and that's that Expedia plans to spend more on paid search in 2018. And we're going to look at some direct quotes from Mark, their CEO, but given solid progress at HomeAway, we plan to lean even more heavily than anticipated earlier this year into paid marketing channels, a trend we expect to continue through 2018. He also talked about the increasing conversion rates they're seeing on their platform, their increased ability to be able to track paid or performance channels from a ROI perspective. And as they're getting better and better at those things, they're going to lean more into paid search, aka we are going to spend more on paid marketing channels through 2018. And they already talked about, in other parts of the call, they talked about that they spent more in 2016 in these channels than they anticipated, which actually led to a big part of what led to the reduction in their margins. Being able to spend more in those channels led to them reducing their margins and reducing their forecast for those, which is ultimately what led to that drop in stock price. So they're getting more customers than they've ever gotten, but they're spending more to do it than they've ever spent, is kind of the takeaway of that. So as we look ahead at 2018, paid search will get more expensive in 2018 as OTAs expand their spend. And this isn't just going to be Expedia expanding their spend. They are, and that statement's been made. TripAdvisor has also made a statement that they're expanding their spend as part of their third quarter's earnings call. I haven't personally analyzed Pricelighting's earnings call, but I would bet you that they said the same thing. And if they didn't say the same thing, I would still bet you that they're going to do it. The major OTAs are all increasing their pay-per-click spend or their paid advertising spend in 2018 and making plans to do that. They spent more in 2017 than they planned to and are spending more in 2018 as a result of what they saw in 2017. We see Airbnb continuing to spend more and more in paid search as well. So as the competition between all these OTAs, Airbnb, Expedia, Priceline, TripAdvisor, Google is sucking up a lot of traffic there as well. And the way Google is directing traffic is actually lowering traffic in certain cases. So there's less traffic available in some cases, while there's more people competing for it and willing to spend more to do it. So that's a really big deal. More people competing, willing to spend more than they were in the past with less inventory available. So if you look at a basic supply and demand chart, less supply, more demand, the price is going to go up significantly in 2018. In 2017, we saw price kind of across the industry as a whole double for a lot of clicks. Now, we used a lot of strategies to insulate our customers from that and use a lot of aggressive bid strategies to keep our customers' costs from doubling in 2018. And we're not predicting if they're going to double or triple or whatever in 2018, but we are predicting they will increase significantly. There's just no way that they won't. Competition is driving that price higher, which leads to the question of what role should paid search play for you? And not only what role should it play for you, it's a very important question, but optimizing to get the most out of your paid search. One of the questions we have with a lot of our customers, especially those who spend significant amount of money on paid search, is how do we optimize the site? Because the better our site performs, typically the lower our cost per click is actually going to be. The better site we have, the lower our cost per click is going to be, and the better our site performs from a conversion perspective, the better the value is going to be. So Google's responsibility is to deliver a click for us or a visitor for us at a predetermined price or inside of a predetermined price range. They have no control over what happens to that person once they get to your site. You have control over that with your web developer, both in how you design your site, the quality of your site, the quality of the content, the quality and the number of conversion opportunities that exist. And as you drive those things higher, as you drive quality, on-site experience, page speed, all of these indicators of a quality site higher, your conversion rate will go up, and your conversion rate going up increases the value of every click. And at the same time should lower the cost of those clicks. So really important takeaway from that. As you're investing in improving your site, the value goes up because your conversion rate goes up and your cost goes down, which is like I don't even know how to say it, but it's like you're winning on both sides of that equation. So investing into your website and the performance of your site is going to be more important than it has ever been as you're trying to compete with the OTAs for direct bookings. That's why you've heard, if you've been on webinars with us before, you heard us talk about our future-proof website platform that we've launched, which I believe is an unbelievable value play in the overall market. And if you haven't heard us talk about it or you haven't seen it, drop me a note and we'll definitely talk to you about it. But we believe that that's part of the future that we're investing into with that platform. And as part of the future you need to be investing into when you're making decisions about your website. Where is the future going? What is my role in that going to look like? And how are these different marketing channels going to feed that? How is paid search going to play? What role is it going to play in 2018 for me? And what do I need to be doing with my website as a result of that? Tons of really important questions, and now is the time to be asking them. Now is kind of a slower season for a lot of us. A lot of our customers, with the ski destinations being the exception, but a lot of our customers right now are seeing slower traffic, and it's just what we know about this time of year. But come Jan 2, that traffic is going to come on hot and heavy. Bookings are going to be coming on hot and heavy, and we need to be ready to go. So you need to be asking these questions. You need to be formulating plans. You may not have everything implemented and done and ready to go by 2018, although that's possible. You can have a lot of things rolled out still by 2018, but you need to be going after it. You can't sit and wait and see how it's going to play out. You have to look at where the future's headed and make decisions now about what that is going to play for you. And we want to help you make those decisions, and we're going to make some resources available to you later in the call to be able to help that, or to help that reality for you and make those decisions and looking ahead at what's going on in the marketplace. But understanding the role paid search will play in 2018 in your marketing strategy is a really important thing we all need to be considering. So what's the future of subscription listings? That's something that was very pointedly addressed, and I apologize for this huge quote. I usually don't try to read off of slides, but I'm actually going to read this for you verbatim because I want you to really take away from it. But Okerstrom said, in terms of mix between subscription and PPB or pay per booking, on the host side of things, I'd say generally the trend has been to shift to more pay per bookings. It's hard to say exactly where it will go. I mean, I think that all of the hosts are trying to figure out what's the optimal break-even point for them. But I think increasingly as HomeAway transitions to, a real marketplace model and starts introducing things like the accelerator program, which like we've got on the hotel side, I think it may be the case that pay-per-booking hosts just have a better ability to compete in that marketplace, but time will tell. But the trend is definitely towards more pay-per-booking. So let me unpack that for you a little bit. Back up to what we talked about with that value proposition. They rolled out a 6% service fee to travelers because they believed they were providing greater value to travelers than they were getting compensated for, and they were right. And it has been hugely profitable for them. Now we're addressing subscription versus pay-per-booking, which is on the host side of things. And he's talking about generally the trend has been to shift to more pay-per-booking. But if you actually break it down, as he talks about with the what's best for the hosts, when it comes to strictly break even, and I would say most hosts would choose the subscription model because most hosts make enough money that the 8% pay-per-booking model isn't necessarily the best fit for them. So they choose the subscription model. But he is also saying that the trend is towards more pay-per-booking, which doesn't necessarily make sense other than that we see it in their numbers because their subscription revenue is down 37% while their transactional revenue is up 116%. So the revenue substantiates what he's saying here. But he also says, I think increasingly as HomeAway transitions to a real marketplace model and starts introducing things like the accelerator program, I think it may be the case that pay-per-booking hosts have a better ability to compete in that marketplace. So let me unpack that a little bit. He doesn't say what he's saying exactly, but he is basically saying pay-per-booking hosts will have a better ability to compete in the HomeAway marketplace. Now, is that because they're only going to make certain tools available to pay-per-booking hosts? Maybe. Is that because pay-per-booking hosts are going to see their properties rank higher because HomeAway is going to make more money off of them? Maybe. Maybe that's already happening. We don't know. But I think it's very clear from this statement that HomeAway sees the future of their marketplace as a pay-per-booking marketplace. The trend is definitely towards more pay-per-booking. There's no and if or buts about that. When you look at a statement for a CEO to make, there's so much packed into this statement that we have to unpack and analyze as an industry and say, what does this mean for our future? But I think that the most important takeaway is that last statement. The trend is definitely towards more pay-per-bookings. And if you look at their revenue, and this is why we unpacked it at the beginning of our call together today, you look at their revenue changes indicate strategic moves and changes that companies are making. Transactional revenue increased by 116%, making up more than 75% of their revenue. Transactional revenue that basically did not exist 2 years ago now makes up over 75% of their revenue. And at the same time, subscription revenue declined 37%, and they aren't alarmed by it. Those statements, the revenue alone, but the revenue coupled with Mark's statement shows the future of HomeAway is a pay-per-booking platform. There's no and if or buts about it, and we believe 2018 will see the end of subscriptions. I might be wrong about the date. It might be 2019, but I really don't believe I'm wrong about the fact that we will see the end to subscriptions. None of Expedia's sites that existed that I'm aware of before HomeAway had subscription models. They have already converted other sites that were a part of the HomeAway model into subscription only and done away with, let me say that differently. They have already converted other sites in the HomeAway model into pay-per-booking only, done away with subscriptions, which all of that together is an indicator they are going to do the same thing on the HomeAway family of sites, HomeAway, VRBO, all of the sites that make up HomeAway. The question then is your business ready for pay-per-booking? The writing's on the wall. It's abundantly clear that's where the industry is headed. But is your business ready for pay-per-booking? Have you tested scenarios? Have you looked at how much of your business you get from HomeAway's family of sites and said, okay, I get X amount of revenue from this group of sites. If I paid 8% of that, which is the current pay-per-booking rate, at least last time I checked, the current pay-per-booking rate, if I paid 8% of that, what would my company look like? Would I still be profitable? Would I still exist? Would I still be making money? So take that number, eliminate your subscription fee, because you're going to get that back, right? Because they're not going to accept that money anymore. Recoup that expense, but instead line item it at 8% of revenue they contribute. And ask yourself your question, what does your company look like at 8% with the percentage of revenue you have coming from that channel? And I would say do the same thing at 12% and the same thing at 15%. Because if they're going to do that, which every single indication says they are, you need to be prepared for the scenario at 8%, 12%, 15%. Once you look at the financials, once you look at the forecast of that, you can then say, what do we need to do? Because if this is coming within the next 12 months, and I believe that it is, you need to start planning for that today. Assuming that you don't like what you see. Maybe you like what you see. Maybe you like your model at 8%. Maybe it's actually a better model for you and you should have been on pay-per-booking all along. Or maybe you already are on pay-per-booking and it doesn't matter. It's not that there's no change for you. But you have to know. You have to analyze that and develop a plan accordingly. Because if you wait until they announce it, and the other site that they did this with, the other site that they pushed this out, they announced it basically like 2 weeks before they implemented it. So it wasn't like they gave you a year notice. This is your year notice. I'm giving you your year notice. They're not going to give you a year's notice. They're going to say, we're no longer renewing subscriptions. The current subscription you have is good until the end of its contracted date. After that, you will automatically transition onto a pay-per-booking model at X%, or we'll take your listings off of our platform. And you've got to be prepared for that scenario. You have to know what your strategy is. If you don't, you could be faced with a very difficult decision and no real way to make that decision in a very short amount of time. So I would look at, you've got to understand when your renewal dates are, and you have to model what it looks like for you with the revenue you're getting from these channels at 8%, 12%, 15%. Now those percentages are made up except for the 8%. 12%, 15%, those are made up. But when you look at what Expedia does in the hotel industry, they're charging anywhere from 15 to 30% of a booking that they deliver. They're also not passing along real guest contact information even after the booking. Pre-booking, we're not getting it anymore. After the booking, the hotel industry in most cases doesn't get it either. So you have to personally collect it from the guest. So it's a really big deal. And you've got to model that. I can't stress that enough, that you should be using this downtime to, assuming you're in a business with downtime, to model what this looks like, to model what your business looks like with these pay-per-booking fees, and to develop a game plan of how you're going to increase direct bookings and what are you going to do with your subscriptions? What are you going to do with your listings? Are you going to accept the change or are you going to drop them? You've got to have answers to these questions so that when the gauntlet drops, you're not surprised by it. So are you ready for 2018, right? That's the burning question. Is your website up to date and ready to book? I talked about how important that is, and then how important that future-proof website platform is. And we've spent a lot of time and money investing into that, and we're constantly making that better. Does your site load in 3 seconds or less? Because if it doesn't, you've got a problem. Is your page speed score doing well? I would say that's kind of gross generalization page speed score. There's a lot of other tests you should actually be running for site speed, but your website and its performance is really important. Have you recently tried to book a property on your site or book a room on your site? Is it seamless? Is it a great experience? Do you have a strategy to increase traffic and direct bookings? Do you know what you'll do if HomeAway eliminates subscriptions? That's the ultimate question you've got to answer, and develop a game plan for 2018. So to try to help you with that, we're offering a free marketing strategy consultation. We'll share marketing data on what we're seeing across the industry, examine your website to determine if it's ready to accept more or drive more direct bookings, and we'll help you develop a strategy to make 2018 the best year yet. So as an attendee on today's webinar, we offer that as a free service at the end of a lot of our webinars. We want to make that available for you as well. So we're launching a poll here, should be popping up on your screen any minute now. Would you like a free marketing strategy consultation? No pressure to say yes, but please say yes or no so that we can get votes in on that poll. It helps us get everything going. If you say yes, we'll get in touch. We'll schedule 30 minutes to chat about a marketing strategy consultation, answer questions that you have, help you understand how to start shaping your 2018 strategy and what to do about that. So if you could just check yes or no. No, thank you. We won't get in touch. No big deal. That's absolutely okay. But just ask that people vote for us. We have to get about 70% of people voted before GoToMeeting or GoToWebinar will let us push that forward. So if you haven't voted, please do that. Just check yes or no. Again, I don't care what you check. It's all about if you want the value or the benefit of having that conversation about that. So looks like we're just a couple of votes short of that 70% mark. If we could get a couple other people to vote here, that would be great. In the poll, yes or no, doesn't matter to us either way. And then if you have any questions, please drop those in the chat panel. I don't believe I've seen any of those popping in throughout our webinar yet. So if you have questions, please do drop those in there, and we will get those questions answered for you. I know there's a lot of information in today's webinar, less kind of how-to from a strategy perspective than we usually do. But any questions that are out there, we do want to get those answered for you. So awesome. Looks like we've got the votes on our poll here. So let me go ahead and get that closed out. If you didn't get a chance to vote, do that now, and we'll get this closed. Perfect. And then jump in and answer any questions that people have. So if you have any questions, please drop those in the chat panel. It's about 1:42 p.m. Eastern time. So happy to answer any questions that you have and go from there. Looks like there aren't any yet. So if nobody has any questions, we can go ahead and sign off of today's webinar. I know it was a very different webinar as far as topics go, but if there are questions, I want to get those answered for you. Looks like we did. Actually, a couple thank yous popping in there. Not questions, but thank yous. And you all are welcome. Glad you guys checked in for this, and we will be sending a copy of the recording out as well. See a question here about that, but we'll be getting a copy of the recording out. With that and no other questions in the chat panel, we will go ahead and sign off for today. Thanks, everybody. Have a great rest of your day. We look forward to talking to you again soon.